as we approach new highs or new lows, and people become very quick to flip in their sentiment. So that's one last addendum that will help you with your technical analysis into understanding all this. We have the basics of looking at the chart patterns, looking at where the price has been, where are we in the overall structure, is there a trend, where is support and where is resistance levels, and how does this fit in conjunction with the big weekly picture. And if you look at your weekly charts on the market, you could see that the oscillators had actually all pulled back down. You could make a case for like it being a fourth wave type of correction on the weeklies. And then how do the sentiment indicators govern where the price trades within that trading range? And it'll all start to make sense. Now, these are just some basic principles of technical analysis. They do not ensure your success as a trader by any means. You know, the main point I wanted to make is that all the information is given to us right there in the price. Okay? The better that you get at being able to look and analyze raw price data, be it bar charts or watching the tape, the faster you will be as a trader. I would say that 90% of the indicators that we tend to use in our canned programs, and I use them too, are price-sensitive indicators, and therefore they'll always be one step behind the price, be it a volatility indicator such as a standard deviation or an ADX, or an oscillator, a momentum oscillator. They'll all turn one day behind the actual price, or one bar behind the price. So be aware of where you are in the overall structure, what the setup condition is. That's what technicals do for us. They tell us what the initial setup is. And then you have to have something that triggers you into that trade. All right? You either need to say, okay, I'm going to buy it if it breaks a trend line, a buy stop, I'll use a volatility breakout system, I'll enter on a higher close, I'll enter on a test of the low. But once you have your initial setup, then you're looking for your condition that's going to trigger you into that trade. And then the third component of the trade, of course, is the trade management. Now, all four of these authors emphasized in their writing the use of stops. And not for the reasons that you might necessarily think. They're very clever in understanding human nature. Of course we use stops for money management, to protect ourselves, to build our confidence, to have the confidence to take a trade in the first place, because some of these setups could, put you on the edge of your seat just a little bit. But if we say, okay, I'm going to buy the S&P and I'll risk 3 points, so I know that's the most that I can lose, it makes it a little bit more palatable to go in and take the trade. But here's another reason for understanding why trade management can be so important. If you enter a trade and you manage it properly, that means putting an initial stop, moving that stop up to break even, or perhaps, as Wyckoff suggested, even a little bit higher to cover your costs of commissions. And by properly managing a trade, by moving the stop up, what that does is that keeps you from taking profits too soon for fear of a reversal. Okay? And that is a very critical concept, because I would say that when a good trade comes along, the biggest mistake people will make will be taking profits too soon. Okay? I'm all for selling into strength and buying into weakness, but 1 out of 10 times you might just catch a good one. And if your weeklies and your dailies set it up, and if you can understand how to manage that trade, it will keep you in it a little bit longer than you might otherwise be. So the trade management really is helping manage the heads, the psychology side. Now, all four of these men wrote in the early 1900s, and what I want to do is I want to read off about 5 basic principles that deal with the mental side of trading that all 4 of them wrote about or mentioned at some point in their writings. First of all, I want you to understand that these men devoted themselves to the market. They studied charts, they pored over past history, they wrote incessantly, they all had advisory services, they all traded. Of course, half of them were bedridden from severe illnesses, so they couldn't do anything else but study the charts. And what I'm trying to say is their life was the markets. So all four of them were very serious, dedicated students, looking constantly at charts and behavior, and they were able to boil it down to these very simple concepts that I just mentioned to you. The action-reaction, definition of a trend. And you have to understand that these were not concepts that had been introduced before at this time. So it really helped actually put enough sense into the market that it encouraged the individual speculator to come into the markets at this time. And they had never done that before. It actually encouraged the individual speculator to start trading stocks. And so this was a new phenomenon. So they all devoted it. They all did intensive work by hand, charting by hand, writing by hand, keeping notebooks by hand. And I have to tell you for myself, I would say that this has been the biggest key to where I see people making it or breaking it. The people that take the time to either keep a notebook, write numbers down at the end of the day, keep bar charts by hand, are the people that I see that are consistently staying in the business. And I have to share a story with you. I was in Chicago a couple years ago at one of the firms I do business with, Sakura Delsher, and I had the opportunity to meet Leo Mohammed, who used to be head of one of the exchanges there, and has been in the markets for a long time. And of course, me and a friend go into his office, which had to have like $500,000 worth of artwork, cherry wood panels, this beautiful desk, the type that you can push a button and the little electronic screens come up out of a thin 2-inch slit, everything there, right there at his fingertips. And you know what he had on his desk? No clutter or anything, but his charts with pencil on graph paper and a little ruler. And he's like, come here, come here, come here. What do you think? Is this a head and shoulders? Is this a head and shoulders, He's always biased to the downside there on the short side. I'm like, I don't know about that, I just try and figure out the next 5 minutes there so I could keep myself out of trouble on that one, But my friend was so excited. He's tugging at my sleeve. He's like, look at that, look at that. Leo's charting by hand, he's doing the hourly charts. And, Marty Schwartz, who is another trader in Florida that lives about 3.5 hours south of us, keeps hourly bar charts by hand, graphing them by hand. I've seen people graph the ticks or the premium levels by hand. This is very integral to getting your feel and building up your confidence level in the market. So all of these men did a tremendous amount of work with just pencil and paper, and that's something that I think gets overlooked a little bit today. Now, all four of them would be the first to tell you, and they actually put this in their writings over and over again, if you read between the lines, that even though they have their theories or their structures of market behavior, that actual practice and theory are two entirely different things. Okay, so even though Wyckoff had this model for a sequence of the way that price behavior unfolds, he'll tell you that the darn stuff works differently every single time. And you know what Elliott wrote in his book? He wrote that, he didn't actually write his book, somebody else wrote his book, but in his writings, he wrote it took him 3 years to figure out how to put his own theory into practice. And this is the guy that originated Elliott wave analysis. It took him 3 years to figure out how to use it. How long is it supposed to take us to figure out how to use it, So, the actual practice and the theory are two different things, but we still have to have a structure or a model in our head. The next thing they will tell you is that the frailty of human nature ultimately is going to always be the thing that we're battling against in our trading, our own emotions. And they all said that there's a certain temperament out there that you either have to develop or you're born with or whatever, but a certain temperament that will favor success more than another type of temperament. And so you always have to be on guard to check your own emotions. Your best insurance against yourself is to have a trading plan before you start the trading day.